we've got this concept now of foreign branches versus foreign subsidiaries. These are entities within a group of entities. We want to understand the difference between a foreign branch and foreign subsidiary. Now, these are two ways that U.S. companies can structure their international operations. Both have different implications for federal income taxation. So we'll see foreign branch on this slide, and then we'll deal with a foreign subsidiary in the next. Now, a foreign branch, this is going to be a direct extension of a U.S. company's operations in a foreign country. It's not a separate legal entity, but rather a part of the U.S. parent company. So it's just going to be another, think of it like a department. For federal income tax purposes, the income and expenses of the foreign branch are reported directly on the U.S. parent company's tax return, and the foreign branch's income is subject to U.S. taxation in the year that it's earned, regardless of whether it is repatriated or not. Now, if you're not familiar with what repatriated means, it means bringing the money back to the U.S. for it to be taxed in the U.S. The U.S. parent company may be able to claim a foreign tax credit to offset foreign taxes paid by the branch. We got an example here. Well, a U.S. software company, which is called TechCo, sets up a branch office in France to expand its European market presence. The branch office operates under the same legal entity as TechCo. TechCo reports the income and expenses of the French branch office directly on its U.S. tax return and pays U.S. taxes on the branch's income. As such, TechCo can claim a foreign tax credit for the French taxes paid by the branch. The last thing we want to do is have double taxation on something like this. Now, double taxation does exist on corporations. One, it's on the profits, and then it's on the distributions through dividends. But this would technically be triple taxation if you were paying French taxes, U.S. taxes, and then taxes on distributions of the profits. A U.S. branch would be the counterpart of a foreign branch, where a foreign company sets up a direct extension of its operations in the U.S., operating under the same legal entity as the foreign parent company. Now, just like a foreign branch, the income and expenses of the U.S. branch would be reported directly on the foreign parent company's tax return in its home country. The U.S. branch's income would be subject to U.S. taxation, and the foreign parent company may be able to claim a credit in its home country for U.S. taxes paid by the branch. With that out of the way, with branches, make sure you understand that, and we are now going to compare them to our foreign subsidiary. Now, a foreign subsidiary, this is going to be a separate legal entity created by a U.S. company in a foreign country. The subsidiary operates independently from the U.S. parent company, although it's usually controlled by the parent. For federal income tax purposes, the income of a foreign subsidiary is generally not subject to U.S. taxation until it's repatriated, meaning, again, the profits are transferred back to the U.S., and then we need to be taxed on that. Thankfully, for the exam, we don't have to worry about taxation of repatriated profits to the U.S. as dividends or other forms of distribution. However, certain types of passive income earned by the foreign subsidiary, such as Subpart F income, which is something we will see in a bit, may be subject to U.S. taxation even if not repatriated. Get another example here. We got the same tech company. The same U.S. software development company instead establishes a separate legal entity in Germany called TechCo Germany, GmbH, to expand its market presence here. TechCo Germany operates independently from the U.S. parent company. As such, the income of TechCo Germany is generally not subject to U.S. taxation until it's repatriated to the U.S. as dividends. However, TechCo may still be subject to U.S. taxation on certain types of passive income earned by TechCo Germany, such as Subpart F income, which, again, we will see later on. Even if the income is not repatriated, when dividends are paid to the U.S. parent company, TechCo may be able to claim a foreign tax credit for German taxes paid by the subsidiary. Now, in summary here, the primary difference between these two is the timing of when the income is subject to U.S. taxation. That's big. Timing of taxes is that's a whole industry in and of itself. Income from a foreign branch is generally taxed in the year it is earned, while income from a foreign subsidiary is generally taxed when it is repatriated to the U.S. parent company, except for certain types of passive income. So for this, more so just know the concepts behind the differences between foreign branches and foreign subsidiaries. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.